how much home can you afford if you make, let's say, $100,000 per year? I mean, with home prices continuing to go up and interest rates high, affordability is at its lowest. So that's what I want to talk about right now, today. If you make $100,000 a year, what kind of home could you afford to purchase? I want to run through a couple of mortgage scenarios so that you can start to gain an understanding of your potential borrowing power. I do have to start with a disclaimer, though, because ultimately everyone's financial scenario is different. And just because you make $100,000 per year doesn't mean that the numbers that I'm sharing today will be exactly the same for you. So always make sure you're connecting with a mortgage professional. I mean, come on, hopefully me, and going through your entire financial picture, running the numbers based on that day's interest rates and your debts and your credit score so that you can move forward in the home buying process with confidence. And oh yeah, one more thing before we get started. If you find value in this content, please do me a favor and hit that thumbs up button and subscribe to my channel so you never miss content on home buying and the real estate market. So today, I want to walk through two scenarios if you or your household makes approximately $100,000 per year using an FHA loan and a conventional loan. Each scenario will look slightly different as each program has different guidelines that you as a buyer must meet in order to qualify. First, let's consider an FHA loan. And I want to start with FHA because it's the most lenient loan program available in terms of qualifying. It requires a minimum of 3.5% down as long as you have a minimum 580 credit score or better. So the first thing that we want to look at, especially as lenders, is your income. So $100,000 per year. Now, let's assume that some sort of an hourly rate or salary that gets us to that. And we're going to use your gross income before taxes. Now, why do we look at your gross income and not account for all the things that you have coming out of your paycheck, like your 401k contributions or your taxes that you pay to the state or federal? Ultimately, it's because everyone has different exemptions and files slightly differently. So this just keeps it simple and consistent across the board. So a lender will take your $100,000 income and simply divide it by 12 to get a monthly amount. In this case, $8,333 a month. Now, I want to preface, if you're self-employed or commission or variable income, this could change. And with self-employed, we typically look at net income. The next thing to determine how much home you can afford is to figure out your debt to income ratio, or DTI. And this is exactly as it sounds, your monthly debt compared to your monthly income. With that, there's a front-end ratio and a back-end ratio. And I know that seems complicated right out of the get-go, but it's important because lenders will talk about it. And the front-end ratio is just your housing payment compared to your income. The housing payment that includes the principal and interest, property taxes, and homeowners insurance, as well as HOA and mortgage insurance. The back-end ratio is all of the other things. It's the housing expense that we just mentioned, plus the other debts that show up on your credit report. Things like credit card debt or car payments and student loans. FHA allows up to a 47% front-end ratio. And I've seen as high as a 57% in some cases for a back-end ratio. Now, I do want to point out that if you're really stretching it all the way to the top on these debt-to-income ratios, you may need to have more to qualify. Meaning, you might not qualify with the minimum 580 credit score or that minimum 3.5% down. You might need a 700 credit score or 5% down. But again, all of this is dependent on your entire financial profile, which is why it's so important that you're working closely with a lender, because there's a multitude of factors and calculations that come into play. So back to today's example. The front-end ratio would be your gross monthly income that we calculated earlier of $8,333 multiplied by the 47%, or 0.47, which gives you about $3,916 to spend on a monthly housing payment. Our back-end ratio can go up higher to $4,750, which is 57% of that monthly gross income. Now that we know an approximate amount that we can spend on housing, we can start to determine an appropriate purchase price. Today, interest rates are playing a big role in home buying affordability. While the rates change every day, let's use 7.125 as an example. Given this rate and a salary of $100,000 and a down payment of 3.5%, you're most likely looking at a purchase price of around $450,000. Now, let's break that down. Warning, there are a lot of numbers coming up, but it helps when you understand how a lender gets there. A $450,000 purchase price with a 3.5% down payment makes your loan amount $434,250. But FHA requires all of its borrowers to pay an upfront mortgage insurance fee, and that's 1.75% of the loan amount right now. So that loan amount of the $434,250 multiplied by 1.75% is your upfront mortgage insurance fee. In this case, that's $75.99. I have to add that mortgage insurance amount back onto the loan to get your new higher base loan amount. So your loan amount with an FHA in this scenario is $441,849. FHA does allow you to pay that upfront fee out of pocket at the closing if you choose, and if you get a lot of seller credits, you might want to do that. But most people simply opt out and they finance it into the loan amount. So using an interest rate of 7.125, your principal and interest only payment on that loan amount would be $29.77. But we're not done there. I mean, on top of that, you're also going to have property taxes. Now, these numbers vary across the country, but the national average is 1.1%. If I use that number, your property taxes would be about $413 a month. We're still not done because you also have homeowners insurance, which also varies greatly. So let's estimate that to be around $150 a month or $1,800 a year. Then there's one final fee that we have to account for, which is the monthly mortgage insurance. So not only on an FHA loan do you have upfront mortgage insurance premium, but you also have a monthly mortgage insurance, which right now is 0.55% of the loan amount. Now, as I mentioned, it's required by FHA and it stays put for the life of the loan unless you put 10% down, which it will fall off after year 11. So your monthly mortgage insurance in this case would be around $203 a month. Once you add all of that together, you end up with a mortgage payment of $3,743, which does fall below that front-end ratio requirement of 47%. You have to be mindful of your other monthly debts. As long as your other monthly debts don't exceed $1,006 per month, you'll meet that back-end ratio of 57% as well. In fact, if your monthly debts fall significantly below $1,000, you might even be able to squeeze that purchase price up even further. Now, I know that was a lot, but if you're still with me, let's quickly walk through what a scenario could look like using a conventional loan. Now, conventional loans are stricter in terms of qualification, the biggest piece requiring a lower debt-to-income ratio than FHA. Looking at conventional guidelines, they typically allow a 45 back-end debt-to-income ratio. Remember all the things, maybe even up to 50%. So those with higher credit scores and minimal debts tend to prefer conventional loans. because their purchasing power can be increased because they're not hit with that upfront mortgage insurance premium. Now, remember, if you're putting less than 20% down, you'll still have a monthly mortgage insurance, but it falls off after you've hit a 78% loan to value. So it's not for the life of the loan. All in all, there is no one-size-fits-all loan program. Every borrower is different, and what works best for one definitely does not work best for all. So if you're curious about what your numbers could look like, please reach out to my team, myself. We'd be honored to run through your profile and all the calculations in order to select a loan program that best suits your needs and your financial situation. Well, that's a wrap for today. It was a lot, and I hope to talk to you soon.